Good afternoon, traders. This is Shane with Futures.io, coming to you live from chilly Cassopolis, Michigan, and streaming across the planet. We are pleased to have you here. Thank you for joining us for our 420th webinar event. Today, it is my pleasure to welcome professional trader, CEO and founder of Habitus Capital, and Ironman triathlete, Brannigan Barrett. We're going to be discussing the 7 biggest mistakes that traders make every day and how to overcome them by utilizing smart trading tools. After the presentation, we're going to have a Q&A session, so get your questions lined up. And as always, the event is being recorded and it'll be posted on the Futures.io website and YouTube within 24 to 48 hours. Speaking of YouTube, our channel has over 400 videos covering just about any trading topic you care to think of. If you like what you see here today, folks, please do us a favor, check it out, hit a few like buttons while you're there. Share it with your friends and definitely subscribe for all the latest updates. Your likes and subscriptions really help us out with delivering quality educational content. Finally, on social media, you can follow us on Facebook, and you can also hit us up at Futures.io on Twitter. Now, without further delay, please join me in welcoming Brannigan Barrett. Brannigan, how's it going?
Hey, Shane. Thank you very much for the introduction.
Yeah, good to see you, man. Hey, it seems to me that risk management is probably one of the most important topics that traders need to understand it, but it also seems like it's one of the least discussed. Why do you think that is?
I think it's just because of a lack of understanding of how to implement risk management. I think that's what it comes down to. And hopefully after tonight, a lot of traders will have a good idea of how they can actually implement risk management.
Okay, fantastic, man. That's great. I'm looking forward to the presentation, and I'm just going to go ahead and hand it over to you.
Okay, brilliant. So good evening, everyone. Thank you very much for taking the time to join me. I think it's going to be quite a fun little webinar. Typically in the past with these webinars, I've done like a pure presentation, and what I've found is that sometimes there's just too much information coming across. So tonight, I kind of want to leave you with just a few thoughts. And I'm going to interact with you quite a bit as well, just to make it a bit more, entertaining and hopefully wholesome for you as traders. So as the topic suggests, we're going to go through the common trading mistakes that all of us make, including myself, and what we can ultimately do about it. Now, a great quote to start off with, being a fish out of water is tough, but that's how you evolve. Now, this is kind of almost a summary of what tonight's webinar is about. Is in essence, you're going to have to go ahead against the herd because that's where the learning is. Okay, there's, and we'll get to how this plays into tonight's, webinar. Now, our index, I don't necessarily want to go through it, but that's pretty much what we're going to talk about tonight. It's kind of going to follow on itself, but it's all more or less around these trading tools that I'm going to share with you. So there is the index for tonight. We're going to start off with the 7 common unsolved traders mistakes. We're going to look at a trader's timeline. I'll tell you a little story that I thought I'd mentioned, but clearly I haven't told too many people about. We'll talk a little bit about the trading ripple effect and ultimately how that feeds into these trading tools that ultimately solve problems. And then we're going to move on to risk management. I think that's hopefully where a lot of you will gain a lot of understanding. And then just talking a little bit about the power of consistency before we move on to Q&A. Now, the webinar objectives. So every webinar I start, for a lot of you that have been, sort of following me since my 2013 days, this is something I've done from day one. This is ultimately what I want to achieve with this objective. Now, I really want to impart time frame reality. And again, that might not make sense right now, but it will when we move on to the next slide. I want you as traders to take control of your decision-making process. I'm going to very much preach a data-focused approach, and I want to expose you to the power of consistency. But ultimately, my ultimate objective is that all of you go away from this point and you build at least just one tool, if not many, many tools that will solve some of your greatest trading problems. Now, where we're going to start with tonight is that thing called data. And I'm not going to, I'm literally just reading this. This is just data articles that are coming off. But a study published in 2020, 1,600 Brazilian day traders. The sum of it effectively, the conclusion is that, we show that it's virtually impossible for individuals to day trade for a living, contrary to what course providers claim. We observe all individuals who began to day trade between 2013 and 15, effectively 97% of them after 300 days lost money. Okay, very startling statistic. Now, that's one sort of study. Another study was from Robinhood. Okay, we all know the famous Robinhood, and effectively 98% of their traders are not pattern day traders. In other words, 98% of their day traders are effectively just having a punt, okay, a directional outright punt. Another one from eToro, which again, most of you have heard of. 80% of day traders lose money over the course of a year with a median loss of 36.3%. 75% of all traders end up quitting within 2 years. Another one, a Taiwanese study, and this is quite an important one because Taiwanese are quite active as day traders. And in essence, again, showing that, they do note that a small group of about 15% do not earn higher returns net of fees. So again, why am I showing you all of this? Well, given this evidence, why does day trading persist? Okay, why is it so popular? Why are all of you here? Well, what is the purpose of you being here wanting to become a day trader when very clearly the statistics are very much against us? Okay, the authors of all of these studies, what they concluded was that very active traders seem to believe they know more than they really do. Okay, i.e. overconfidence or confidence bias. And what they were suggesting is that overconfidence can explain high trading levels and the resulting poor performance of individual investors. Now, I think that's a wonderful introduction to this entire webinar, because what I'm trying to get across and what I want to ultimately, sort of you to take away from today is this quote, okay, is that my greatest weakness is not that I can't make money, but rather I can't avoid losing money. Now, hopefully all of you can associate with that quote. Why? Because there is 1,001 ways to make money, okay? There's some very easy ways to make money. The problem is it's not that easy to hold on to that money, okay? And that's what these trading tools are about. These trading tools are there to help us hold on to the money. Now, again, another one of those sort of backward types of quotes, and you'll get an understanding of where I'm going in this in a minute, but traders spend 95% of their time searching for ways to make money, okay? Take any typical trader. They always want to know a strategy. They always want a signal. They always want an answer to how they can make money. The problem is they're spending too little time. They're only spending 5% finding ways to avoid losing money, okay? Now, if everyone is ultimately losing money, why are we not spending 95% of our time avoiding lose money and 5% of the time finding ways to make money? Okay, and that's the purpose of this entire webinar, is to get you just to switch your perspective around. Now, we have a real problem, okay, very clearly from the statistics, not me making it up, not me pitching you anything. We have a problem, okay, and there's no viable solution. Now, there's a lot of good education out there. I want to be very cautious to slate educators because, for a large part of my career, I was one of those people that are, trying to help people, trying to get people to understand what is required in order to be successful as a trader. The problem with education is that the education is not geared towards solving the problems that traders have. Okay, now it's not to say education isn't good. It's not to say that education isn't warranted, but it is to say that if you want to succeed as a trader, you need more than education. Okay, you need to solve the problems that are ultimately holding you back. Now, one of the ways to think about it, and I really like this thought process, is that in modern day society, okay, all of us are normal human beings outside of trading, right? If we struggle to wake up in the morning, what do we utilize? Well, we use an alarm clock, okay? If we're struggling for motivation to go to the gym a couple of times a week and get in shape, well, we get a personal trainer. If we want to meditate and, we're very stressed, we use music as a form of meditation. Okay, if we want to count our steps or measure our heartbeat, we get a smartwatch. Now, all of these tools were created by very smart people. They were created to solve specific problems, okay? They're solving specific weaknesses that we have as humans in our personal capacity. Now, trading is no different, okay? We have got personal weaknesses. We cannot, that older days of, work at your weaknesses and, you'll get better. That's a lot of rubbish. Okay. That's something that, sells a lot of, sort of newspapers. But the reality is work at your strengths. Okay. Focus on your strengths and use tools, build tools to solve your weaknesses, right? That's what every, major corporation in the world does. If they have a weakness in their business, they build a tool or a mechanism or a process to fix it. Okay. The best example is the airline industry. Okay, if you go look at the airlines over the last couple of years, you will see whenever there's an airline crash, whenever there's something that occurs, that there's a loss of life, they make changes to the processes. They adjust every single time. Okay, so that's where you want to start thinking towards. How do I build tools that can solve my weaknesses, as opposed to let me try and just improve on my weaknesses through whatever other means. Now, the important question is, do practical tools solve real trading problems? Okay, and where I'm going with this is that there are currently some trading tools in the market. Okay, think EdgeWonk. Okay, I know a lot of people talk about EdgeWonk, which is one of these trade journals. Now, EdgeWonk serves a very important purpose. Make no mistake, it enables us to begin to recognize patterns within our decision making. The problem with an EdgeWonk, and the problem with every other tool, again, is that ultimately a lot of the success of a trading tool depends on the timing of intervention. In other words, a trading tool is no good to me if I've already made the mistake and then it tells me I've made a mistake. Okay, because unfortunately, as traders, when we've made the mistake, we pay for that mistake. Okay, and capital is a limited resource, right? Trading is not one of those ventures where if you make a mistake, you say sorry and everything's okay and you get on with it, right? So unfortunately, the trading tools that can, or the trading tools that do work, as opposed to trading tools that don't work, are ultimately preventative. In other words, they intervene into the decision-making process before the decision, okay, not after the trade. Right. And that's why a lot of these, performance tools, okay, there's a lot of performance tools out there and they show you wonderful charts of your performance. But what the heck is that going to help me? Showing me a wonderful, pretty chart, or showing me, how I made a loss, or that's not going to enable me. It's not going to give me control over avoiding that mistake the next time. Okay. In other words, for a tool to be successful, they have got to be preventative in nature. Okay. And that's important to understand. Now, where we're going tonight is I want to discuss the 7 of many. Okay, and this is important. This is not an exhaustive list. This is just 7 random, common, unsolved trading mistakes I picked. Okay, a lot of you can associate with these 7. A lot of you can probably associate with maybe none of the 7, and you probably have your own 7. Okay, the point is we've all got problems. We've all got weaknesses. Okay, and we all need to solve those practically with trading tools. Now, these are the 7 I'm going to go through. We'll move through them over the course of the next couple of slides. So don't worry too much about, taking notes or anything about that. You'll get an understanding of these different problem areas. Now, the first part is the trader's timeline. And this is a massively important one. And it's actually something you heard Shane talk about, me being an Ironman athlete. And this is something that comes from my coach. So I actually have a personal triathlon coach. And the reason I have a coach is to enable me to develop an understanding of myself, the sport, how I approach the sport, but most importantly, it steepens my learning curve. Okay, if anyone ever asked me, is it a good idea to have a coach or to go for trading education? I would say yes, so long as it steepens your learning curve. In other words, it helps you get to where you want to get to just a lot quicker. Okay, if taking a course gets you to your endpoint and saves you time, okay, then it's a good course and it's worth taking. So that's how I tend to measure whether it's education or whether it's having a private coach. Now, my coach actually taught me this concept of a timeline. And I'm going to tell you a little bit of an embarrassing story. Okay, when I was in 2018, I'd completed my first Ironman, and someone said, have a chat with this coach. And I thought, oh, you know what? I want to go to Kona. Now, Kona is pretty much the top of amateur triathlete sport in terms of, Ironman distance. And so I started talking to this coach and I said to him, you know what, coach, I will be the best athlete you'll ever have. Okay, I will do whatever it takes. Okay, I'm motivated. I'm pumped. I've, got all the resources. I'm hardcore. And, I was literally just floating my own boat. Okay. the reality was, I think my coach was just sitting there sort of, scratching his head thinking, what the heck is this guy talking about? Okay. And he taught me this concept of the timeline. Okay. And I've just taken the word trader's timeline, from athlete's timeline to trader's timeline. And what it is showing, what it showed me and what it's showing you ultimately is that there is a predetermined amount of time that you have got to spend in order to get to the end point, which is elite performer. Okay, so if you look on the far right of your screen, the elite performer is the end point. That's where we're trying to get to with any skill pursuit. Okay, it doesn't matter what it is, whether it's becoming a professional trader, whether it's becoming a professional athlete, whether you want to become a professional juggler, it doesn't matter. The process remains the same. Okay, skill adoption takes time. Now, there's different steps to it, okay? And I outlined for traders, I outlined 10 steps, and I'm going to go through them very briefly, okay? And I like to think of them in terms of the Malcolm Gladwell, 10,000 hours concept, okay? Now, what's important to state right here is that every trader is different. Every trader has their own path. The point is, you're all going to have to follow the same rough path. Okay, you're all going to have to learn the same experiences. You're all going to have to do the same sorts of things to get to the same endpoint. That's just how experience accumulation works. Now, year one is what we call a honeymoon phase. It's fun. It's exciting. It's sexy. I get to tell everyone I'm a trader. Okay. Year two, we buckle down and we start to learn the fundamentals of trading, the basics of trading. Year three, we start to learn the foundations. Okay. Things like routine and discipline. Year four, we start to understand the principles of consistency and patience. Okay. Year five, we start to adopt these principles. In other words, we don't just know the principles, we actually adopt them and we utilize them within our decision-making process. Year six, suddenly certain doors start to unlock. Okay. We start to develop certain skills, certain, understanding of market events, etc., etc. Year seven, we finally learning to compete. Okay, this is how we get good at losing and get good at winning. This is how we maximize on our opportunities. Year eight, we start to define our own trading rules. Okay, year nine is where we effectively have no limits trading, and year 10 is that elite performer. Okay, now it's not to say all of you are going to take 10 years to be successful. What it is to say is this is a journey. Okay, it's a journey that cannot be rushed. Why? You are at the mercy of experience. That's just how this works, okay? And because experience comes at a sort of a certain speed, okay, you cannot rush experience. You can't sit in front of a screen 24 hours a day and experience 24 hours of experience. It doesn't work that way, okay? You have to go through the process of experiencing at the pace that the market gives it to you and at the pace that you're capable of absorbing and learning from it. Okay, and this is what we get to, and this is quite a cool little image and a good way to look at it. So either in a hypothetical way, we would love to have the expected journey, that wonderful blue straight line. That's what we would love. But the reality as traders is we go on the random walk. Okay, we've got to go on our personal journey. We've got to learn at our own pace. Now, why this is so crucial and why I've put this right at the beginning of this entire presentation is that so many traders think just like I thought as a triathlete, as an Ironman, okay? I thought we started at year 10. I thought we get to be elite from day one. I thought that, I'm going to come out racing and be a superstar on day one. The reality is that through my own self-discovery, and fortunately, I've got a very good coach, through my own self-discovery, I realized where I was on this timeline. Okay, I realized what I needed to do to get to that endpoint of elitism. And to this day, I still recognize, I know where I am on my pathway. Okay. So it's important that you recognize yourself on your own journey. Recognize that you cannot expect to be an elite trader. You cannot expect to be making significant amounts of money if you've only been doing this for 1 or 2 years. Why? Because you're still learning. Okay. You're still trying to develop the skills required to become an elite performer. Now, the best way to look at this, the analogy I love using with this is, imagine a doctor that goes to medical school for 5 years, does all the theory. Imagine after those 5 years of theory, they simply come in on day one and they start cutting up people or doing open heart surgery. Okay. There is a very good reason that a doctor won't be doing open heart surgery for at least 7 to 10 years in most countries. Okay. It's because they need the prerequisite amount of experience and wisdom before they can start to do open heart surgery. Okay, we are no different, and it's important you understand that if you want to be an elite trader, if you truly believe that this is your career path and this is what you want to do, then you've got to accept that a skill pursuit takes time. Okay, so that's what we're talking about here in a timeline perspective. And the issue traders have, the problem traders have, is they cannot see this big picture. They cannot see this as a timeline. All they see it as, oh, I got 6 months, or I got a year, I got to make money, this next trade's got to make money, otherwise. The problem is when you start to narrow the focus like that and you don't see the big picture, you're working against yourself. Okay, you're working against the natural flow of, what your own pathway will be. Now, there's this wonderful expression, to know is not to adopt. And this comes from Stoicism. And the Stoics were very, very strong on this. And what they were saying was knowing something is not the same as adopting this. Okay. And this plays well into the tool section because we all know the theory. Heck, I know the theory and I still make mistakes every single day. Okay. So knowing is not the same as adopting, right? In order to adopt, okay, we have to personalize things. Right? So it has to become a personal experience. And when that occurs, we get the true wisdom as a result. Okay. Experience is just the sum of all failings. Hopefully, you know that by now. Hopefully, as traders, you've started to recognize that, unfortunately, in this venture, you're going to fail a lot. Right? But if you can accept that failing is part of the process, you'll actually start to get good at failing. Right? It's not about accepting failing. It's not about, thinking that, it's okay to fail. It isn't. But it's about recognizing that you're going to fail and doing something about it. Okay. Now, the trick is that accepting you'll need to experience it firsthand as cheaply as possible. And this is where the tools come in. Right? If I told you today that you are going to fail, you're going to fail a number of times over your career. If I told you this is a fact, as I showed you the statistics earlier, okay, then the art of this game is to fail as cheap as you can so that you can survive for as long as you can. Okay. Now, it's that willingness to fail wisely that will ultimately unlock the wisdom. That's very, very important to understand. Okay. Now, the purpose of a coach and education is not to prevent you from failing. Okay. My coach doesn't stop me from failing. He lets me make the mistakes. He lets me, do stupid things. Right. But his job and my job as, as a trader and him as the coach is ultimately he's there to prevent me from failing. He's there to get me to fail safely. Okay. He's there to get me to learn from that failure. And he's there to help me implement a practical process to avoid similar failure in the future. Okay, that's the key. That's why you do education. That's why you have a coach. And that's why you build trading tools. Okay, the trading tools are there to ultimately protect you. Okay, they're not going to stop you from losing money, but they're there to protect you from having the big failure. Okay, so they're there to help you fail safely. Right, they're there to help you learn through those failures. And they're ultimately there to help you avoid making similar mistakes in the future. Okay, now, a little story, okay? And this is important because from this story, you'll start to get an understanding of where this whole trading tool mentality came from, okay? I started trading in 2011 and I didn't start on day one building trading tools, okay? No, I started just like all of you. I looked at a chart and I saw 3 green candles and I bought, okay? That's what I did, I just looked at a chart and thought that's trading. Right? I started thinking I was elite. I started, right at the 10-year point when I should have been starting at the 1-year point. The result is, as you can all imagine, blown out accounts, having to spend a year and a half not making any money, learning the game. Okay. It was no different for me. I just happened to be ahead of probably a lot of you, and some of you are probably ahead of me. Okay. But this is a story that led me to this point of developing tools. It was that sort of, aha, maybe I actually need to do something different to get a different result. Now, context is 2017. I was living in North Greenwich, London, so Canary Wharf side. And I even remember the day. It was a very interesting day. Now, EIA, okay, so most of you know oil inventories. The last 3 releases, for some reason, the number didn't matter. Okay, the number was completely irrelevant. The market was just reversing, and it was reversing aggressively straight line. So, just literally the market would blip down and it would straight line reverse and take out the high of the day. Okay, and it did it 3 weeks in a row. So Obviously, the traders on the floor, we were talking it up. We were all, pretty hyped up about it. There was this new opportunity to make some easy money. So I went to the risk management. I said, look, I've got 30 lots in oil, double it for me. Okay, this one's working, it's good. And he ultimately doubled my limits. Okay. And this is probably an hour or two before the oil inventory release. Now, at that point, my trading account was 240,000 sterling. So from a risk manager's perspective, okay, the account can handle it. All right, a 60 lot in oil with a 240K account is fine. Now, my comfort stop, okay, like I said, at that point, I had what we call a comfortable stop. This is the stop that if I lost it, I'd be annoyed, but, I'm comfortable with it. This wasn't predetermined. This wasn't risk management. This was my comfortable stop. And my typical clip in volatility was 5 lots. Okay. The outcome, market blipped down. I remember it quite distinctly. I just instantly bought 10 lots. I didn't even care where the price was. I just hit 10 lots. And it then kind of moved very aggressively down again. And I just went bang, and I hit another 20 lots. So now at this point, I'm 30 lots long. And I'm like, well, this thing best start to do this reversal thing. It's been doing the last couple of weeks. And then came the ultimate sort of flush. It's just almost a blip off of my screen. And I did what instinctively I've done all my career when a market blips. I just went all in, and I pushed all in, and I was 50 lots long. And I don't know, a couple of brief moments later, it just kept going down. And eventually I just puked and got out of the trade, and there was a 38 grand loss on my account. Okay. Now, what I want you to do, and this is that interaction part, hopefully as I'm going through that context, a lot of you are saying to yourself, well, that's stupid, oh, that's stupid, oh, that's stupid. So can you identify from my experience, what are the problems and mistakes within this very real, life example that I've just shared with you? Okay. Have a think about that. Okay. More importantly, can you associate yourself with some of this, sort of manic, type decision making? Okay. Now, as you're going through that, what I'm going to show you on the next page is I'm going to show you what we talk about the ripple effect. Okay. So within this example, within this scenario I'm showing you, a lot of traders, including myself, right, we're going to point to something very specific in this day that ultimately led me to that loss. Now, as traders, because we're emotional beings, okay, because we're subjective by nature, we always identify the wrong thing. Now, the problem with this is if we cannot identify the underlying cause of a problem, then we cannot solve that problem. Okay. Now, remember, what we're trying to do here is build trading tools to solve problems. So we cannot build a trading tool if we don't know what the real problem is. Okay, so hopefully you've identified some of the problems and the mistakes that I've made within, the lead up to this massive loss. Now, they're there on the left side. Okay, so first off, overconfidence bias. Okay, I've come in, the floor is excited. Everyone's talking about the 3 reversals in the oil the last couple of weeks. Subjectivity bias. Okay, straight away, I'm assuming the market's going to reverse. Okay, I don't really care what price action does. I'm just going to fade it. Sample size, 3 releases. Okay, I'm literally basing a decision on 3 releases. I've gone for an additional limit request. Okay, so I've doubled my limits. In other words, I've doubled my leverage 2 hours before a pretty volatile event. Planning and preparation. Okay, how much planning and preparation went into this if I'm requesting limits 2 hours before? Typically, I trade 5 lots. Now I'm trading 10 lots. Okay, so I've increased my leverage effectively 100% more than usual. Compounding errors. Okay, I've gone from a 10 lot to a 20 lot and another 20 lot, and I've effectively compounded what was the first mistake. Okay, so I've gone and I've averaged using 40 lots for the first time. Using 50 lots for the first time. Okay, never used 50 lots in my life in oil. Okay, suddenly I use 50 lots in one of the most volatile, illiquid, moments of the week, and ultimately I've lost 16% of my account in the day. Okay, so these are ultimately the, if we to call it anything, this is the stupidity. It's like, this is all the errors that have gone wrong. Okay, now I have specifically not put them in any kind of, I've put them in a bit of a random order, right? Because most traders will look at this and they'll say, well, the real mistake you made was actually you used 50 lots for the first time. Okay, most traders, if you're not used to using any kind of size, and typically a big position for use 20 lots, to suddenly use 50, right? that's a pretty big position. Okay, most traders will stop there and say, well, I wasn't comfortable with the size. The trade was right. It just didn't work this time. The size got me out too quick because actually, by the way, the market did come back above, sort of my average price. So I could have got a scratch at some point. Okay. So most traders lean on that. They say to themselves, well, I was just too big. I was too big too early. Next time I'll get it. Okay. Some traders will say to themselves, well, I probably shouldn't have requested additional limits. Maybe the risk management's a little bit to blame there. Maybe he should have done something about it. Okay. Now, hopefully you can see in this entire situation how a trader's psychology, ultimately is feeding into this, because we're not taking responsibility. We're not identifying the underlying problem. Okay. All we're doing is we're kind of pointing to what we think was the problem. Okay. Now, let's say for hypothetical purposes, I did identify the problem as I shouldn't have doubled my limit request. Okay. We can create a very simple procedure for that. I can go to the risk management and say, don't allow me to request limits, and I can only do it once a month. Okay. That's a very simple solution to solve this problem. But have we solved the true problem of this entire episode? The simple answer is, of course, we haven't. Okay, this goes back a lot further, and that's what we talk about when we talk about the ripple effect. Okay, the ripple effect, what we see is the big ripple. Okay, that's the loss. We see the big 16,000K or 16% loss in the account, the 38K loss, right? But we have to work our way backwards. We have to see, how the heck did we get to that point? How did we get to minus 38K? Okay, and that's what we do now. We do that by recognizing and identifying what are the uncontrollables in the situation and what are the controllables. Okay, and the very first controllable of the entire sequence, that is the one that we need to solve. In other words, if we solve that first controllable, there is no possibility for a ripple. Okay, in other words, we cannot get to that extreme point of a 38K loss. So let's look what that ripple looks like. Okay, and we identify it. So this is in order now. This is the order in which I would have done this rippling effect. So the first and most important thing to solve is the planning and preparation. In other words, there wasn't a sufficient amount of planning and preparation that went into this entire episode. Okay, had I solved that, okay, had I planned correctly, there would never have been an overconfidence bias. Okay, yes, I still would have faded, right? But I would have recognized that, okay, sample of 3, yes, the last 3 weeks, it's, ultimately reversed. But through looking at the last 3 weeks, what I noticed, the initial flush down, it went bid straight away. The next 1 minute candle was a green candle. Therefore, because of that preparation, I would have still faded the market, but I would have recognized when there was no similarity from the last couple of examples. Okay, so it's the planning and preparation that allows me to sidestep the overconfidence bias. Okay, now subjectivity bias and sample size of 3 releases, those are uncontrollables. I cannot control that. Okay, so I do not need to look at it because I can't control it. Therefore, I cannot find a solution to solve it. Now, again, the additional limits. If I was planning correctly, right, I would never have needed to go to the risk management. Why? Because if I typically use 5 lots, all right, and I've got 30 lots, if I feel confident about this trade, well, maybe I put on 10. That's still double what I normally use. Maybe I put on 15. Okay, but through effective planning and preparation, I would never have got to the point of asking for more limits. Okay, the same with the compounding errors, right? Had I not gone for more limits, right, and I planned correctly, I wouldn't have averaged. I wouldn't have got up to 50 limits. I wouldn't have used 50 limits for the first time, and I wouldn't have lost 38,000 for the first time. Okay, so that's the ripple effect. It's how do we get to that endpoint? What caused us? Not the thing we think it is. What was the starting point? Because that starting point is what we have to create a trading tool for. Okay, now this is the lesson. The trade would have still lost money, guaranteed. There was no ways I was going to sidestep the loss. Okay, because the trade outcome, which is uncontrollable, was such. But no controllable errors would have been committed. In other words, if I planned and prepared well, I wouldn't have committed a controllable error. Okay, and those are the errors. Control. This entire webinar is about taking control of your decision making. Now, the objective of this ripple effect is to interpret the true underlying error. What was the real cause? And solve that practically. Because if you solve that, you're going to solve your problems. Now, the solution is, how do we solve the problem of a lack of sufficient planning and preparation? And that's where we get to the trading tools. Okay. Now, I'm going to take you through elements of what we call the SRM tool. Now, this is a tool that I developed and I started developing in 2018. And I've been very fortunate to work with a company called Pixpo Consultants. They are, in essence, the gurus behind building the tool. I am the trader. Okay. Now, before I can get you to the tool, I need you to understand what we call the trading process flow. Okay. It seems a lot more complicated than what it is. But again, what we're trying to do here is we're trying to identify within our decision-making process as traders, where do we control elements and where do we not control elements? Okay. Now, what you're looking at here is 3 different phases. You've got the pre-risk phase. So before I take any risk, before I put any trades in the market. Okay. We've then got the risk phase, i.e. now I've got a trade in the market. And we then have the post-risk phase, i.e. I'm now out of the trade and I can now, do something about it. Okay. Now, in the pre-risk exposure and the post-risk exposure, okay, we have full control on our decision-making process. Why? Because we've got no risk on the table. Okay. We're not subject to any kind of biases. We're not subject to emotion. We can be holistic and objective. And it's in these 2 timeframes, in the pre-risk exposure, right, that we're utilizing our trading tools. Okay. And it's those trading tools that are enabling us to be in control, so that when we put a trade on, okay, once we, finally sit down and bang, I'm going to hit 100 Apple shares, at that point and only at that point, there's nothing to think about. Okay. And the reason we call this the trading process flow is because if you can build the right type of trading tools that ultimately control all the situations that you could potentially find yourself in, by the time you are actually live in the market, the only thing you are focused on is managing that trade. Okay. And we call that the objective decision-making process. In other words, you can be wholly objective. Why? Because you don't have to think about anything else. Okay. And the best example I like to use in terms of trading tools, think of one trading tool. Before you get into a trade, before you buy those 100 Apple shares, you should already know exactly what your risk exposure is. You should know exactly how many shares you're going to use. You should know exactly where your stop is. You should know more or less what you're trying to do with that trade. You should know what the trade strategy is. You should know everything about what you're about to do before you do it. If you can do that, you are in what we call the trading process flow, or also known as trading in the zone. Okay, Mike Bellafor very cleverly captured that word, trading in the zone. It actually came from elite sportsmen, by the way, being in the zone. But in essence, what he was leaning on is this idea of, if you take care of all the controllables, you can be in the zone. Okay. Now, how do we take care of all the controllables? We build the prerequisite trading tools. Okay. We build the tools, we put them in place so that they are there to enable us to make objective decision-making. Okay. That's all the slide is showing you. It's showing you that we want to be objective once we have risk in the market. Okay, when there's no risk on the market, that's when we can spend time building things, developing things, working on strategies, etc., etc. Okay, now rules. Before I get onto a tool, right? Remember, I want to give you some ideas for building tools that you can solve your own problems. But before I can give you some ideas, I have to give you some rules. Okay, otherwise you're going to waste a lot of time, which fortunately I've wasted that time already for you. So, first and foremost, identify the real problem, the ripple effect. Okay, what is the real problem? If you don't know the real problem, you're not going to find a real solution. Develop the solution process. Okay, in other words, you've got to find that process that the solution will ultimately solve. Okay, solve your trading problems practically with proactive, real-time trading tools. Okay, and this stems from that idea of there's a lot of trading tools out there that are not real-time. They're what we call Harry hindsight trading tools. Oh, I took a massive loss today. The chart shows me that. Well, heck, great, thank you. That didn't prevent me from, taking the loss. Okay, they need to be proactive. In other words, you got to think of them as a coach that steps in and says, "Hey, Brannigan, whoa, you sure you want to add another 10 lots in that oil?" Okay. That's what you need to build. You need to be building proactive, real-time trading tools. Okay. Automated functionality. I see it far too often. Traders building an Excel sheet where they're logging their trades. Guys, what the heck for? If you're still logging your trades, right, you are wasting a lot of your time. Okay, so think of the input-output ratio. You want to literally type in one button and get massive amounts of output. That's where you need to be in terms of building your automated functionality. Okay, preventative nature, right? Now, one of the reasons it must be preventative is because it must force change. Okay, now one of the things I'll show you in a moment is when I'm over risking. Okay, so if I'm over leveraged in a market, I've literally got an algorithm that screams at me. It says, you are over risked. Okay, and it's like you can load up your own audio file as well. It's pretty cool. Right? The point is that it forces me, it scares the shit out of me when I hear it because it's very loud. Okay, but imagine what that does. It suddenly takes me out of this, what we call the continuous mindset flow, where I'm in a trade, I'm so focused on what's going on, and suddenly this thing shouts at me. Well, of course I'm going to take notice. Of course I'm going to stop and go, well, actually, yes, this is for my own good. Okay, so it forces change. Data, 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 data. Okay, I cannot stress how important data is, right? The data doesn't lie. The data is just a number. Okay, the data shows you the clues. It unlocks all the potential opportunities within your decision-making process. Okay, ask the right questions, right? Traders are so bad at knowing what the right questions to ask. Why? Because they're afraid to hear the answers to. Okay, so ask the right questions of your data and you'll get some meaningful answers. Benchmarks, okay? And we'll talk a little bit about benchmarks later, but you've got to have your progression benchmarks. In other words, if I'm trying to become a better trader, what do I need to work on? Okay, more importantly, what can I build that will show me that progression? Right? Why? Because guess what? Just like training for an Ironman, being on a bike every day, as you can see behind me, or running, it's boring. Okay, it gets very boring. But when I see my numbers, when I see my data, when I see I'm getting stronger, faster, quicker, right, that's my benchmarks. Right? And that keeps me moving, that keeps me progressing. Simplicity, okay, and this is one of the most overlooked. The tools I'm going to show you today, be warned, they are going to seem like they are wow and fantastic and super complicated. They're not. Okay, in principle, remember that process, that solution process we spoke about in line number 2. They are very simple solution processes. Okay, so keep your tools simple. Why? Because that's the power in them. And then the last one, does this tool add value? And this is a very difficult one. Okay, and take this from someone that's been building trading tools for 3 years, right? A lot of my tools, unfortunately, I invested a lot into them, okay, but they don't add any value, right? They're missing that value add element, which means they are not effective. Okay, so just be aware of that. If it doesn't add that value, if it doesn't solve that problem, change it, adjust it, get rid of it, and find something else that does solve the problem. Okay, so these are the rules for building effective tools. Now, these are the common unsolved traders mistakes. We've spoken about that timeline perspective. So how do we ultimately get a better timeline perspective? Okay, now this is a fancy chart, and it probably looks a lot more complicated than what it is. But what I love about this chart, okay, is that ultimately what we're doing here is what we call a projection, a forecasting. Okay, and this works very well for young traders. Okay, what I say to them is, I'll say to them, you have, say, something like a $10,000 or a $20,000 account. Okay, and they go, yeah. And I say to them, well, what if I told you that within 12 months you could have that account at 100K? And they'll go, oh yeah, how? Tell me how. And I say, well, you've just got to be consistent over a period of 365 days. And they go, oh yeah, I can do that. I can do that. Okay. And this is ultimately what that chart is showing you. Okay. It's plotting a few things. The first thing it's plotting is, what is your current account balance? That's this black line with a red in between. Okay. So the black line is, what is my current account balance? Now, when that account balance dips below my initial investment, it just goes red. Okay. That's all that red line is showing. Now, with that account balance, what we can forecast, we can work out what is your average growth potential. In other words, what are you doing on average to your account on a day-to-day basis? Okay, and with that number, we can project what your 3-month, account will look like. We can also project what your year account will look like. Okay, something so simple. Think of the simplicity of that. What I'm saying is, if I on average make every day 0.5%, what will my account look like in 3 months from now? What will my account look like in 1 year from now? Okay, now just having that ability to see the forest, Suddenly I come in every day and I see this chart and I'm like, well, I don't have to do a thing today. I don't have to force the market. I don't have to change my style. I don't even have to change my size all that much. I just got to keep doing what I'm doing and I will get to that point that I want to get to. Okay. So it gives me a timeline perspective. Now, this is one of the tools we use to develop timeline perspective. It's to get you out of that thinking any moment or any trade or any day is that important. It isn't. Okay, what's important is consistency over a long period of time. Now, the next failing or the next thing a lot of traders struggle with is no strategic objective approach to trading. Now, you would have heard a lot of people talk about not having a business plan, okay, not having a trading plan. And that's what this is. It's not having a plan ultimately of what we're trying to achieve. Okay, now this is something I failed with a lot in my career, even to a large degree, if I'm honest, and I put my hand up, I'd say still to this day, I really struggle with this. Okay, and what this is suggesting is, if you asked me, what am I trying to achieve for the Habitus Capital Fund this year? I'll just tell you, I want to make a really good return on investment. Okay, unfortunately, that is not a sufficient objective. Okay, not in this day and age. Okay, if you want to progress, you've got to have a very specific target, because if you have a specific target, you can then put in place certain parameters that you need to achieve to get to that target. Okay, and that's what this is. So I've got a number of calculators, I think 10 or 11 different calculators, and there's two on the screen, and they're very simple calculators. I'm going to show them to you. Okay, the first calculator is what we call an account balance growth. In other words, what it is telling me as a futures trader, okay, most of you are futures traders, what it's telling me is, if I have an account balance of $100,000, okay, and I ultimately want to make a 25% return this year, okay, so I come in and I say to myself, you know, I'm a swing trader, I'd love to make 25% return on my investment. That's fantastic. Okay, if I typically trade 200 days a year, so the yellow boxes, by the way, are inputs. Okay, so I'm simply inputting, you know, what I want, you know, what my inputs are. What it then calculates is it just simply tells me that if my parameters are, that's my account balance, that's my desired return, and that's how many days I trade on average, it's telling me that, Brannigan, all you need to do to achieve your target of 25% with this account is make $125 a day. Okay, and that equates in the E-mini S&P to 10 ticks a day. Now, can you see how, if I was just an E-mini S&P trader, I just wanted to do a couple of trades a day, I want to make a 25% return a year, you know, maybe I was retired or whatever. Can you see how just having a very simple calculator can help you to determine an objective, which is, okay, my goal for 2021, I want a 25% return. I'm going to come in every day, make my 10 ticks. When I've made my 10 ticks, I switch off and the day's done. I come back the next day, I repeat. Okay, so a very simple tool, but what it does is it allows us to ultimately start to set objectives, but set them by understanding what is required to reach those objectives. Okay, and this is the problem. Most traders have a 100K account. They want to make $1 million. The question is that feasible? Okay, yes, it's feasible, it's possible, definitely, but you're going to have to take on a lot of risk to get to that point. Okay, now that's the important part, which is, if you want to make $1 million with 100K, right, then you have to recognize that you're going to have to take on more leverage. You're going to have to risk a greater percentage of your account. And if you're okay with that, well, then you can strive towards that objective. The point is, these tools allow you to understand what is required in order to achieve those objectives. Now, if you know what is required, you can do something about it. Okay. So the next tool, calculator I love is this, what we call a fastest period to hit target. Okay. In other words, we're all in a rush. We all want to make a certain amount of money. Maybe we want to buy a house, whatever it might be. Okay. Let's say I have 100 grand and I really want to double my money. Okay. If I double my money, I can take the 200K out of my trading account, put it as a house deposit, whatever. Okay. If I typically make $250 a day, how many days will it take me to reach my target? Okay. And very simply, all the tool is doing, all the calculator is doing, is it's telling me it'll take me 400 days to reach this objective. This is the fastest I can get to that target. Okay. So again, all it's doing is it's allowing me to have a holistic approach to what I'm trying to do. That's all these calculators are. Nothing fancy, nothing overcomplicated, but they serve a very specific purpose. Okay. And that allows us, through all these calculators, we can start to build an objective approach to trading. We can start to formulate a plan. Okay, and if we've got a plan, then we can start to figure out how we're going to get to that endpoint. Now, I'm going to skip the risk management one because we're going to spend all the time at the end with that. But very, very simply, I'm not going to go through benchmarking. I'll touch on it, okay? But benchmarking is just simply saying to ourselves, if I want to be an elite performer, okay, if I want to be the best trader and be the biggest trader, what are the metrics? What are the things I have to look at in order to get to that point, okay? One of the examples I like to use is what we call under and over risking. In other words, over leveraging and under leveraging. Okay, if you want to be a successful trader, the reality is you cannot under risk and you cannot over risk. Okay, you've got to follow a very strategic risk management system. So what we do is we watch that performance. We watch how we are under and over risking over a period of time, and we work towards the benchmark. Okay, what is the benchmark? The benchmark is having zero under and over risking. Okay, so every time we do have it, we adjust. Okay, in order to get to that, what we call ideal point. So our benchmark is what we would ideally like to be. Okay, and that's what we're striving toward. Now, we can do all sorts of metrics for benchmarking. And this is the metrics I look at. Okay, so at the end of every day, I've obviously got my guardrails in place, and I'll talk a little bit about guardrails in a moment. I've got my general trade performance in place. I've got my strategy performance. So I look at my strategies in general, and I look at my risk management efficiency. Okay, so I look at how efficient am I being as a risk manager. Now, again, don't look at this and think that this is anything other than what it is. This is just a series of very cleverly asked questions. Okay, so I'm looking at my data and asking very specific questions. And if I can ask the right kind of questions, ultimately, I'm going to be able to get better towards those benchmarks. Okay, now, one of the ones I love to look at is something we call size efficiency. And I'll show you a chart of what this looks like in a minute. But all size efficiency is, okay, it's one of those clever questions of the data. What it's saying, and this is futures traders will be able to associate with this, what it's asking of my data, it's saying, how many prices do I extract out of whatever market I'm trading? How many prices do I extract for every one lot that I trade? Okay, now why this is important, the psychology of traders is that when we use more size, 3 lots, 4 lots, 5 lots, whatever it might be, we have a tendency to change our approach to trading. In other words, we maybe start to not run it as long as we do. Maybe we start taking more scratches. So what the size efficiency is showing me, it's showing me how efficient am I with using size. Now, the benchmark is a very high number. Okay, benchmark is the highest possible number. I'd love to take 100 ticks for every one lot I use. Okay, whereas a very low number is ultimately a very poor benchmark reading. Okay, so ultimately, I want to view that benchmark over a period of time and see how it's improving. Okay, because that's how I know I'm getting better with regards to this thing called, strategy performance. Okay, now the process for development, and this is something that traders are very bad at. Okay, what we're talking about here, and again, don't worry about the errors that I'm calling them. Focus on building tools to solve certain problems. Okay, so traders don't know how to develop. Okay, when I'm struggling with the bike behind me, right, I go to my coach. I say, hey coach, listen, I'm really battling with a session. Can you give me a few things that I can work on? And he says, sure. And he goes and outlines, and he'll prescribe a couple of sets for me. He'll say, okay, you need to work on this, you need to work on that, you need to work on that. Okay, and that's that process for development. It's no different for a trader. Okay, now, 2 things I love to look at for process of development is, one is the size effectiveness I showed you, and that's in this chart below. And the one I'm just going to discuss with you is this actual lots versus allocated lots. Okay, all this is showing me, think of it as a distribution of the amount of size or the amount of lots you use as a trader. Okay, now what this shows you, it takes all of your trades. Okay, it takes all of your data and it distributes the amount of lots you are using, but it also distributes the amount of lots you should have used. Okay, so the recommended lots is the dotted line. Okay, in other words, that's a risk management system saying you should have used 2 lots 100 times. Okay, so we had 100 trades where the system told us to use 2 lots. Okay, we only utilized 2 lots 90 times. Okay, so we can very clearly see that what we did and what the system is recommending to us there is variance. Okay. Now, seeing this, we can compare this 3 months to the next 3 months, and we can suddenly start to see how we are improving. Okay. From that point, from the simple chart, we can develop a process for development. Okay. More importantly, hopefully a lot of you are trying to grow your account. You're trying to build the amount of size you use. And what we can see through distributing our lots is ultimately how we are getting better at improving size. In other words, we want to see our distribution shift to the right. Okay. Sounds complicated, but it isn't. Okay. Now, another one of those tools, okay, we call this guardrails to avoid disaster. Okay, now I love guardrails. Now, all a guardrail is, think of walking down the stairs as you're exiting a plane flight. Okay, we tend to hold on to those rails. Why? Because heck, we don't want to slip and fall because it's going to hurt and we're probably going to embarrass ourselves and look silly. Okay, so guardrails are there to prevent us from disaster. Okay, and there's all sorts of guardrails you can develop. All right, very simple ones. You could have a simple stop on an Excel sheet that has a function that says, if you reach a certain dollar loss on the day, shut down the Excel document or play a certain video, or there's a number of different things you can do to prevent yourself from ultimately going further. Okay, so the guardrails are just simply there to prevent us from making big errors. Now, there's a number of different guardrails you can develop. I like guardrails which we call over and under exposing. Okay, so if my risk system says use 10 lots and I use 12 lots, I want to know about it. Okay, if I'm trading without using my risk system, which is this trading without risk, I want my system to know about it. Okay, if I'm trading with insufficient risk, in other words, I'm stopped out on the day, I want my system to tell me about it. Okay, if I've reached a certain stop on the day and I don't want to trade anymore, the system will tell me about it. Okay, so guardrails are just very, very important preventative measures. Okay, they're there to stop you. They're there to avoid you getting to that point where you, oh man, I wish I didn't do that. Okay, how often do we say to ourselves, I wish I didn't do that? Okay, that's what the guardrails are there for. They're there to prevent you from getting to that point. Okay. And then accountability. Now, again, I know I'm pushed for time and then I want to get to the Q&A, but accountability is something that traders are really, really bad at. Okay, we hate taking stock and we hate, admitting and we're recognizing our weaknesses. Now, this is what we call an accountability trading calendar, and what it ultimately is measuring. Okay, if it's my goal to do a 45-minute debrief every single day, because I know that debriefing and doing reflective analysis improves my trading. Okay, the trading calendar is simply logging that data. It's telling me, okay, on Monday, I did 35 minutes or 45 minutes. On Tuesday, I did my 45 or 45. On Wednesday, I only did 25. Okay, it's logging my data. Okay, I can't cheat the data, right? The moment I start the debrief process, there's a countdown clock and the clock says ding. Okay, and if I finish my debrief early, it logs the data. Okay, and this is why that automation process is so important, because when we start capturing this data, we are then accountable to it. Okay, because we can't change it. Right now, if we can't change the data, we can come at the end of the week, we can look at this and we say, you know what, this week actually, I did 100% debriefs, that was good. Okay, maybe I need to work on this and maybe I need to work on that. Okay, so being accountable then allows us to obviously develop for further improvement. Okay, now this is where we want to get to. And guys, thank you. I know you're all staying on. I appreciate that. This is what I want to get to. And this is where I kind of would hope all of you start. Okay, start with a risk management system, something very simple. And I'm going to take you through a very, very basic mathematical risk system. Okay, now I adopt 5 different risk systems. I only use one at a time. Okay, and I choose the risk system based on the account's objectives. Okay, so the Habitus Capital Fund has obviously got a swing type strategy, as well as obviously the leveraged futures fund. Okay, they adopt different strategies for different reasons. Okay, those reasons are based on the objective. Right? If I want to take a smaller account and, I don't mind having 20, 30, 40% drawdowns, okay, then I'm going to use a very different risk system to, if I want to, keep things tidy on the downside, but still have decent enough upside. Okay, so the system you choose is dependent on your objectives, and that's crucial to understand. The system I'm going to expose you to is what we call the equal risk weighting system. You've all heard of it, I promise you. Okay, now, very briefly, The systems you can see that I'm outlining for you in a brief sense, they go from a more risk averse system to a more risk appreciative system. Okay, that's the only distinction. We're using slightly less leverage and we're using slightly more leverage. Now, a lot of you are probably thinking, well, surely I'd always want to use more leverage. And again, it depends. Okay. And ultimately, it depends on this, which is what are the advantages to using that risk system versus the disadvantages? Okay. Every risk system has got pros and cons, every one of them. Okay. And every risk system is better suited dependent on your style, dependent on your risk approach, dependent on who you are as an individual. Okay. So a risk system is very personalized. The most important thing when you choose a risk system, do not change it. Okay, you've all heard every trader that wants you to be successful always tell you, oh, you've got to have this risk strategy and don't change it and just stick to it and the numbers will play out. Okay, well, a risk strategy is no different. You change the risk strategy, unfortunately, the power within the mathematics behind the risk strategy, the power within the compounding effect of the risk strategy, the power within the basic, mathematical, strength of the strategy. If you start to change your strategy, you're going to lose all of that. Okay, so you have to be consistent in your risk management approach. Anyways, equal risk weighting. Okay, I'm going to give you an example of it. It's very simple. If you typically do 5 trades a day, okay, and I wish I could get a pen up, but I can't. If you do 5 trades a day, actually I can annotate. Bear with me, guys. I just want to figure this out. So you do 5 trades a day, okay, and you typically have $1,000 loss on the day. Okay, so this is your daily stop loss. Now, this is for day traders. For swing traders, it would work slightly differently. Okay, but you typically do an average of 5 trades. Now, these 5 trades comes from your system. Okay, so your system calculates you've been trading for 1 year, and over the period of that year, you calculate that you do roughly 5 trades a day on average. Okay, what the equal risk weighting system is doing is saying, well, if you do 5 trades a day, well, then it makes sense for you to risk $200 per trade. Okay, now a lot of you are going, oh, I've heard this. Yeah, equal weight. That's very straightforward. It's stupid. It's silly. The reality is this is probably one of the most powerful strategies. Why? Because of its simplistic nature. Okay, and if and only you willing to adopt this for a consistent, long enough period of time, will you actually see the power within this approach? Okay, now I'm going to say something at this point, which is that, and we said it right at the beginning, traders focus all their attention on how to make money as opposed to how not to lose money. Well, a risk management system, by the way, is how not to lose money. Okay, this is the system that protects you from not losing money. This is the system that when you lose, you're only losing small amounts. Okay, now the advantages of this system, very simplistic, okay, easily understood and implemented, very basic math calculations. Okay, strong, consistent methodology. It's not biased by subjective probability statistics. Okay, what we mean there is, some of you obviously know Kelly criterion, or you allocate percentages, based on the trade strategy or how the trade performs. Okay, in that instance, it is subjective. Okay, you're inviting subjective nature in. Okay, and it's the perfect to learn the power effective risk management. In other words, this is very good for beginner traders. Okay, every young trader that I've ever taught, every young trader that I've come across, I've always said to them, start with a very simple risk system. Okay. Disadvantage, well, it doesn't allow you to maximize your profit potential using probabilistic outcomes. Okay, in other words, if one trade is better than another, unfortunately, you're going to be risking the same regardless. Okay, so you can't capture that probability efficiency. You lose the power within effective leveraging. Okay, so as said, you can't effectively leverage this because you're using the same $200 regardless of the trade. Okay, very slow account progression. I remember I said to you, if your objectives are to take it from 100K to 1 million, well, then unfortunately, this isn't a trade strategy. This isn't a risk strategy that's going to work. Okay, why? Because you need a very high tick rate win. What is the right amount of average daily trades? Okay, so again, this trade strategy is very dependent on the number of trades you do per day. Okay, now there are ways to improve the strategy, and we can have that discussion another time. There's lots of ways you can tweak the strategy. You can create little mathematical tweaks to it. That's not for this webinar, but that's the basic equal weight system. Okay, now, how do I get to the next slide? Okay, there we go. Now, this is where we get to, and this is the crux of it. Okay, what you're seeing is my front-end risk portal. Okay, this is ultimately what I see all day, every day. And all this is, it looks a lot fancier than what it is. It's a system that's telling me this thing right in the middle. And sorry, I can see my annotations are still up here, but I want to clear all drawings. This is ultimately what the system's telling me, okay? And this comes back to that slide I showed you where you have pre-risk, you have during risk, and you have post-risk, okay? What this tool does, what a risk system does, is it enables me as a trader to take care of everything that needs to be taken care of pre-risk. Okay. In other words, by the time that I've got this thing called a live trade, I don't have to think about anything. Okay. Everything has been predetermined and predefined. Okay. Now, this is where I want you to kind of go away and think about tonight, because too many traders are thinking about risk once they've got risk on the table. Too many traders are thinking about where the stop should be. They're thinking about how much can they afford to lose. They're thinking about what percent of their account they should be risking. They're thinking about all these things. The reality is, if you find yourself thinking about those things and you've got risk on, you're doing yourself an injustice. Why? Because you're not taking control of all the possible controllables. Okay. And that's your goal from this webinar, is to go away from today, look at your approach, look at your, what we call your process flow. You know, in other words, that point before you take a trade and that point after you take a trade. Identify everything you can control. Take care of that with trading tools. Okay. So that when you enter a trade, all you are focused on is, what is that market doing? Okay. What is the objective information coming from that market versus, you know, what it should be doing. Okay. And again, we can create another tool for that as well, called trading cue cards or performance cards and all that kind of thing. But we're not going to talk about that tonight. So this is a basic risk management system in which, as I showed you, the equal rating system, we're willing to lose $1,000. We simply load onto our Excel. Okay, by the way, this is all in Excel. Okay, you all have access to Excel. You simply load it onto Excel. You tell Excel, what's my stop size? And Excel says, hey man, okay, you're willing to lose $200 per trade. $200 divided by 15 ticks equals X amount of lots. And it says to you, you can use whatever, 2 lots in the oil trade. Good luck. Okay. And that is what a basic risk management system looks like. That is, if anyone asks me what's the single most important thing on the screen, it's that right there. Okay. I need to know, based on my mathematical risk model, I need to know how many lots I need to use. Okay. I don't want to think about the lots. I don't care whether I win or lose. Why? Because I know that's all taken care of pre-decision making. Okay. Now, that's pretty much going to bring us to the end. I was going to talk a little bit about consistency, but let's get to the questions if that's okay, Shane. I'm aware that everyone has given me a large chunk of their time tonight. So yeah, if there's a couple of questions, we can go to those.
Hey, absolutely zero problem, man. Great presentation. I really love events that focus on risk, because it really is the most important part to staying in the game and being able to do this long enough to learn how to do it and survive. That really seems to be what it comes down to.
And I think that's the key there, Shane. It's, you've got to find a way to stick it out for 10 years. Okay, I can promise you, if you are all willing to stick this out for 10 years and you can stick around for 10 years and experience the ups and the downs of the markets, you will make a degree of success. Okay, now it's not to guarantee you'll be a multimillionaire, but you will be successful in your own shape or form. Okay, and so the solution to the problem of most traders is more simple than people think. Okay, and it doesn't have to do with strategy focus. Okay, too many traders are focused on trying to find a perfect strategy. I promise you, if I showed you some of my strategies, you'd be like, that's a joke. That can't make profit. The reality is, it's not the strategy that's making me money. It's how I'm utilizing my tools in and around that strategy that's making me the money. Okay, and that's the aha moment from tonight. Okay, is the tools are protecting me, you know, even though some of my strategies are a little bit iffy here and there.
Yeah, you do have to have a valid strategy, but at some point as a trader, you have to decide to stop shooting yourself in the foot.
Exactly.
Well, we've got a question here from PA Trader 65. He would like to know, how do you evaluate the validity of edges on a continual basis?
The validity of trading strategies.
Yes.
Okay. Yeah. Great question. Actually, that is something that I work on within one of my tools. Okay. I look at forward testing. Okay. So a lot of traders focus on back testing to develop a trade strategy. What I do is I actually look at forward testing. Okay. So what that means in a basic nutshell, I have a trade strategy, and what I do is the performance metrics of that trade strategy, I capture all the metrics looking forward. Okay, so let's assume I do a basic strategy, I take that trade the next 10 times, and I then have the metrics for that trade strategy for the next 10 observations. Okay, now what I want to do is I want to observe those metrics to determine whether or not I've actually got any kind of edge in the market. Okay, so hopefully that answers the question, but it's those, too many traders are focusing on past data to determine if edge exists. Okay, for me, it's the future data where the edge is important. And one of the most important things I'll say to a lot of traders out there, okay, most traders focus on something called RR, risk reward. What I would suggest to you is focus on what we call positive risk reward. Okay, and what positive risk reward is, we only look at the trades in which we actually make a winner. Now, the reason we do that, and bear with me, this is crucially important, okay? When you look at R&R, most traders are looking at hypothetical scenarios. Okay, the problem with a hypothetical scenario is it doesn't account for those things called human emotion. It doesn't account for those things, that get involved in the decision-making process. Okay, so all a positive risk reward does is it says, I'm only going to look at the risk reward of my trades where I had a positive outcome. In other words, I ignore the negative outcomes. Okay, and I only look at a risk reward from the positive outcomes. Okay, so hopefully that answers. So I look at things like, positive risk reward, and from that I determine, whether or not there's edge. So I've got 3 or 4 different metrics that I look at that ultimately determine if I've got an edge in the market. Okay, and positive risk reward is one of those elements.
Yep, outstanding. Alex, a fellow Ironman, he had a question regarding the 10-year comment, which we all know about 10 years. He wants to know if it's reasonable to think that he could at least earn a modest living prior to 10 years' time elapsing. He said he's been in markets for 20 years, but he's recently doing more in futures.
Got you. Again, the answer is it depends on how quickly you can expose yourself. Okay, the expression I love is the faster you can fail, the faster you'll start earning money. That's the reality. So it's just about failing fast and doing it safely. But what I would say, I mean, let's put the cliches to aside for a moment. The reality is we got to make money. Okay, we have to put bread on the table. Most day traders I know, the quickest day trader I've ever known to start breaking even was 12 months. Okay, and that was dedicating this as a full-time job. I broke even after 14, 15 months. And I would say within the first 3 years, I had 150K accounts. Okay, so it all depends on how fast you're willing to expose yourself to the markets. That's what it boils down to. But if you dedicate 2 years of your life, I think you will know after 2 years whether or not, one, you're capable, and 2, whether or not you're willing to sacrifice those other 8 years. And because you're a fellow Ironman, it's the same question as for me. The one question that plagues my mind is, how many years am I going to sacrifice to potentially get to Kona? Well, the reality is I will know after, for example, this year, whether or not I'm good enough based on the numbers to be able to then sacrifice another 2 years. It's the same with trading. Okay, so you'll have metrics that'll tell you whether or not you need to keep pushing to get to that endpoint.
Very interesting. Very interesting. I did have a couple. Are you strictly a discretionary trader?
No, I've got. I'm in the process of developing a machine learning algorithm. But I would say my skill set is more focused in the discretionary side.
Right. I think it's pretty much where most people start out. I always thought it was really interesting how athletic training and coaching are specifically directed towards making progress and hitting goals. And that really does kind of translate into the world of trading.
Do you know, Shane, if anyone asks me what's the single biggest sort of aha moment I've had in my personal life, it was getting a training coach. Okay, and I think the one thing that our industry as traders is rarely missing is coaches. Okay, and the reason there's no coaches, and a lot of you are going to push back and say, hey, there are educators. Okay, the problem is you cannot be an effective coach without the right data. Okay. The same as my training coach can see everything I'm doing. He can see my heart rate, my speed, my power, my everything. Okay. He can be an effective coach because he's got access to my data. The problem is we don't yet in the trading industry, we don't yet have the right data. Yes, we've got P&L and those things. But like I said to you in the beginning, P&L is sort of a Harry hindsight data piece. It's not a data piece that can help me improve my decision-making process. So, but I think it's coming. I think that's the reality. You're seeing a lot more data-focused, prop firms now. They are focusing a lot more on data. So, yeah, hands down, the best thing I ever did was get me a training coach. It's enlightened me personally. So hopefully you're all going to be Ironman getting coaches in the next couple of weeks. But first,
Right.
build trading tools.
So then, how do you feel that your physical conditioning affects your trading performance?
Yeah, great question. Yeah, healthy mind, healthy body. Okay, I'm always up for it. If you can suffer for 13 hours or 12 hours or 10 hours in an Ironman, then I mean this job is it's never easy. But it does help. Okay, it's you just get good at you just get good, and it's the dedication, it's the motivation, it's the discipline, it's the everything that comes with being an Ironman. It's not. A lot of people say Ironman's about getting a tattoo or a status. It isn't. Ironman is something that's part of you. Okay, if you're disciplined, or if you do Ironman, you have to be disciplined. You cannot succeed at an Ironman without being disciplined. So it's the personal attributes that come with being an Ironman that I think help us massively as traders. I mean, I cannot underestimate it. Yeah.
Yeah, if you looked at my trading, you'd probably suggest that I should start working out. All right, man. I think we're getting wrapped up here. One more? What prompted you to get involved in trading? You were fresh out of school and that sort of thing. What was the motivation there?
Um, Look, I always wanted to be a brain surgeon, to be fair. But in my final year of school, they told me that I wasn't good enough at science, which is fair enough. So look, I don't know what got me into trading. I liked the markets. I liked the ambitious nature of the markets. I liked the idea of working for myself. And I mean, I was in South Africa, so I'm South African born, and I was working at a brokerage there. And I remember I had a line manager, and I said to him, can I take some positions in the market? I think I can, skim a couple of cents and make a couple of cents extra for the clients. And they said, well, we're not a trading firm. We don't take risk. Okay. They were a risk management boutique firm. In other words, so the short end of it is, there was no trading industry in South Africa. I flew over to London, and I came here for holiday, and then I did an interview. It was all very random, but the next thing, I literally had my life savings in, which was like £1,500. I was 25 years old, very naive, but I was going to kill it. That was it, and I rocked up in London, and I didn't have any job. I didn't have any other options. So I kind of went and worked at this proprietary trading firm. I sat down, didn't earn any money for 18 months, sort of had to borrow a lot of money and take loans from banks and all, but it kind of worked out for me. And that's the one thing I will say. And again, it comes down to that timeline. If anyone ever asks me, I get a lot of young guys asking, can I mentor them? And what I always say to them, it's not about if I can mentor you. It's about what are you willing to sacrifice to get to where you want to get to? Okay, too many young people today feel like they have the right to a certain success. And I would say to anyone, if you truly want this, you're going to have to recognize there has to be an element of sacrifice from your end. Okay. And the way I see it is, there's a couple of guys I look up to. Okay. I'm a big fan of Ray Dalio, for example, or Elon Musk. Okay. And
Yes.
I would go to Ray Dalio tomorrow and say, look, I will work for you for free for, however many years. I just want to be under your tutorship. I just want to be under your mentorship, and I just want to listen and learn. Okay. And that's the kind of mindset you have to have with trading. Okay. If you have that mindset of I'm just here to learn, and I love this, and I just want to do it so that I can become better, at some point it just clicks, and yeah, that's my story. I didn't want a Ferrari. I still don't really want a Ferrari. I like a nice Ford, sort of, I don't know, Ford Raptor with a big bull bar that I can, I don't know, just,
Push things
yeah.
out of the way with.
Yeah, look like a gangster on the road. That'll be fun. But yeah, that was my story pretty much.
Any advice for stopping impulsive all-in trading?
Yeah, guardrails. Okay, guardrails are, I'm impulsive as well. Okay, I still get stopped out frequently. But when you've got a systematic approach in place, and one of the good examples, okay, and what I'm going to implore a lot of you to do is when you're building these trading tools, okay, don't be afraid to reach out. Obviously, I've got a few years of experience. I'll have a few ideas that you can, sort of tap into, but for impulse trading particularly, okay, you need to know what is creating your impulse. Typically for me, it's volatility. Okay, so I will find that my round trips will go from 800-900 on average per day to suddenly 2,500 per day. Okay, now I know that comes with volatility. So I've got a volatility indicator. Okay, which is when I get in the morning, again, one of my tools is a filtering tool, and it'll tell me when the markets are in a volatile nature. Okay, straight away, I'm aware. So there's that awareness because I've got a tool that's making me aware that there is a probability I'm going to be trading more. Okay. Now, from that point, if you typically trade 800 in a day, you can create a simple rule which says the moment I trade above 800 lots, effectively, tell me about it so I can take a break. Okay. Impulsive trading is not the same as trading because there's a lot of opportunity. Okay, so just make sure you understand what is impulsive trading, i.e., is it those gambling type trades? Okay, because those can be eradicated. So again, just simple things of what do I typically do, which is good trading. Good trading is 5 trades a day. Well, if I'm doing 10 trades a day, tell me about it. Okay, make a simple system that tells you about it when you start to impulse trade. Okay, so they talk a lot in trading about continuous flow and discrete flow. Okay. Now, when we're trading, when we have a trade on, when we're in the zone, when things are looking cool and we're making money, we're in a continuous flow. Okay. And it's nigh on impossible to just stop ourselves in that flow. Okay. It's like an addict. We just want more and more and more. Right. So how do we stop that cycle of continuous flow? Well, if you have a very loud alarm, that stops you from being in a flow. Okay. If you have something that flashes on your screen, that stops you from being in the flow. Okay, so create something that forces change. That's that force change. Okay, you need something that intervenes and forces change.
Outstanding. Outstanding. Any parting thoughts?
Yeah, I think just to summarize, go away and build those tools. And I'd love, I mean, I love success stories. Okay, if anyone asks me why I do these webinars, I promise you I don't get paid to do them. I just love seeing people succeed. For me, it's a big sort of, I don't know, it's probably the same as a coach who sees his athlete go to Kona. Okay, I like seeing people succeed. I like people taking an idea and running with it. I also like learning from traders. Okay, so when I engage with a lot of the younger traders, which I do very often, I can learn through them. Okay, I can learn from them. I can obviously share my understanding with them because I'm probably 9 or 10 years ahead of them. But equally, I can, they see things in a different way, and that allows me to, rejig my own way of doing things and improve my own way of doing things. So don't be afraid to reach out. Obviously, my email address is on the screen. In terms of building tools, try it yourself first. Okay, I'm not coding proficient, which is why I used Pittsburgh Consultants. They did everything for me. I was kind of the project planner, and they did all the background coding. So try it yourself. I'm pretty sure if you go on the IO Futures forum, I'm pretty sure you'll get some coders on there. So don't be afraid to reach out within the forum. Okay, I'm pretty sure there's some pretty tech savvy guys that can help you build just very simple, smart tools. Okay, but keep it simple. Right? The most simple applications, the most simple tools will create the most value for you. So yeah, thank you. It was a lot of fun.
Great advice, man. And I want to thank you for the excellent presentation. It doesn't seem like risk gets nearly the amount of attention that it should.
Yeah, and I think what we can do is, if there's enough interest for it, maybe in a couple of months, let's come back to an exclusive risk session. So just pure risk, no other tools but risk, because risk is single-handedly the most powerful tool I've got. Okay, not because it makes me money. It's because it saves me money. That's the reality of it. Okay. It's all about finding ways to not lose money. If you trust that, you'll never look at someone pitching you a trade strategy again because you've got enough of those. What you don't have enough of is trading tools. You don't have enough of those things that stop you from, losing the easy money.
Absolutely. You got to hang on to it, man.
Yeah.
All right, folks, that about wraps it up. Be sure to join us for our next event on Tuesday, April 20th with Alan Majaris of Zytrade, who's going to be going over features of the Motive Wave trading platform. Brannigan, thank you again so much for being with us here today. Really appreciate it and look forward to having you back.
Thank you very much, Shane, and thank you everyone for your time.
Folks, don't forget, please hit that like button on YouTube. Head on over to Futures.io to continue the conversation with Brannigan. Again, I thank you for joining us and trade well.